David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, for a discussion about what's driving recent inflation trends and the potential impact on the economy. David, thanks so much for joining us as always. Well, throughout this year, you've offered your insight into the importance of observing the economic cycle as it pertains to making investment decisions. But today, you're going to focus primarily on the topic of inflation and why this is your primary economic concern.
That's correct. Economists suggest that personal consumption amounts to about 70% of gross domestic product. Well, if that's true, then we should really pay attention to inflation and the impact that such can have on personal consumption. We have heard the terms base effect and transient within the general business media lately. There is very little consensus, though, among economists as to the nature of inflation. Personally, I have maintained throughout that the inflation that we are experiencing today is more systemic than transient. Over the course of the last 2 weeks, however, I have noticed an increasingly greater number of these economists beginning to align behind the thought that inflation is indeed not transient. This is important because if the inflation that we are experiencing now is more systemic, then that would imply higher prices for general goods and services over a longer and sustained period of time. And that is not a good thing if you are looking for durable economic growth.
David, can you help our viewers understand the difference between such terms as transient inflation or systemic inflation? And can you give us an example of what base effect inflation might be?
Yes, I can. Simply put, transient implies temporary. Chairman Powell has often suggested that the higher than average inflation that we are experiencing now is transient. What he is suggesting is that the factors causing the inflation are temporary, and that in the opinion of the Federal Reserve, these factors will abate over time, and we will not be left with higher long-term inflation acting upon the economy. Systemic, on the other hand, implies longer term. Personally, I believe that the forces behind the inflation that we are experiencing today are more systemic than transient. Now, to give you an example of base effect inflation, let me just reference the automobile industry. We went for several months where we made ventilators instead of cars, but the demand for automobiles was still there. Once you're able to reopen the factory and get back to making cars, you can't simultaneously restart your lines of supply. So it takes time to not only catch up, but also play keep up, and it's exacerbated when your supply chains are not turning on simultaneously with your return to making the product. Just last week, Brian Westbury, the chief economist with First Trust, produced a video making this very point. I believe that the Federal Reserve is creating systemic inflation through the debasing of the currency, which occurs when you continue to increase the money supply. As late as last week, Chairman Powell reiterated that the Federal Reserve will continue to support the economy for as long as it takes. He confirmed that the Federal Reserve has no immediate plans of departing from its schedule of purchasing $80 billion worth of Treasury debt and $40 billion of agency debt on a monthly basis. In order to perpetuate this bond buying strategy, the Fed must increase the money supply. With each new dollar printed, the dollars that existed before become weaker in value. A weak dollar is just another way to express inflation. So in my opinion, the Federal Reserve is creating their own inflationary problem through the printing of a record amount of money. This isn't something that can be neutralized quickly. It could potentially require years for the currency to strengthen and stabilize. And thus the inflationary trends that we are experiencing today could very likely be more systemic than transient in nature.
Well, David, on its surface, this does not sound like a good thing if we are hoping to experience a continued economic recovery from the COVID-19 pandemic. How might inflation be detrimental to patterns of consumption?
We could potentially speak for an hour about this very topic. Let me summarize why this is of concern to me by showing you 3 images. First, let's take a look at personal income. Again, there's very little consensus among economists as to why personal income has fluctuated so dramatically in recent months. Some say that extended unemployment benefits have dramatically impacted personal income, while others continue to claim that the one-time receipt of COVID stimulus checks continue to have an impact on personal income. You are now looking at a graphic that depicts the changes in personal income on a monthly basis. Personal income has declined in 4 of the last 5 months. If you simply observe all of the negative and positive changes in personal income, then you realize that such is unchanged over nearly the last 10 months. Personal income is virtually unchanged over the last 10 months. Now you are looking at a graphic that depicts the change in the Consumer Price Index year over year as of last May. The inflation that we feel at the consumer price level has increased by 5.5% over the last 12 months. That is a higher rate of inflation than we have seen in a 1-year rolling period of time since 1991. Understanding that the Consumer Price Index has averaged 2.26% per year over the last 20 years gives me reason to worry that current inflation, running at 143% higher than the 20-year moving average during a time when personal income has remained unchanged, could negatively impact the economy. The third graphic to which I will draw reference is something that impacts all of our daily lives. You are looking at the national average for a gallon of gasoline. Since May of last year, the national average for a gallon of gasoline has risen from $1.80 to $3.14 per gallon. This is an increase of over 74%. Gasoline is an economically inelastic commodity. It touches every aspect of our lives. It is a distillate of oil, and U.S. oil production is down sharply over the last 12 months, so scarcity is playing a larger role. That and oil is denominated in a dollar that continues to weaken. Therefore, the inflationary effects on this economically inelastic commodity in particular are not abating. They are systemic, and these forces continue to strengthen.
Well, it sure seems that we're living in a time of change. So what advice can you give to our viewers in terms of navigating this challenging time?
The answer to that question will be as individualized as your thumbprint. At a very high level, however, we are recommending to our clients that they overweight areas that could potentially thrive under changing economic conditions, and especially in areas of the economy that will benefit from a weakening dollar and higher inflation conditions. There is no one-size-fits-all answer to the question, and it is entirely a function of individualized financial planning and resulting investment strategies for the achievement of individual goals. I would strongly suggest to your viewers, though, that this is not the time for an autopilot approach to investment management. Be aware of changing economic conditions. They are already showing patterns of evolution, and remember that we haven't even received the formal proposal for potential changes into the tax code for next year.
Well, David, as always, thank you so much for the information today. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brannon Dawkins.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.